What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Taya Damavandi. How you doing today, Taya?
I'm doing great. Dan, how about yourself?
I am fantastic, and I know that this is the second time we had a little bit of a hiccup with the internet, but I don't know if you forgot, but today, Taya, we are joined by my very favorite audience member. And why is my favorite member of the audience here today? Well, obviously, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors. That means passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, why would any sane person want to do that? Well, the answer is the SEC gets ants in its pants if you're discussing private off-market deals and you need documentation of your substantive relations, and that is part of what I'm up to. But the benefit for you watching is you'll not only be able to more effectively communicate on the subject of a commercial real estate deal, but you'll also know how my guest fits into those deals. But before we dive straight into real estate, Taya, do you want to introduce yourself a little bit to the audience?
Absolutely. So my name is Taya Damavandi. I am a workforce housing developer. We specifically do hotel conversions. So we take old, distressed hospitality assets. We basically strip them, turn them into multifamily, and put it back on the market for usually lower than market rate rental prices.
I love it. I love it. And the first segment that I do here in each of these episodes is the five distinct motivations. But I don't know what your level of technical acumen is, but I have to say, but wait, check your eight. Taya, I don't know if you could try and look through the camera and then down there into the user's device, but there might be this big, hideous subscribe button that maybe they should do something about. It's just down there and it's free. Okay, it's a stupid joke, but whatever. I've already done it hundreds of times. Okay, so exactly. There you go. All right, the five distinct motivations. It's absolutely true that everybody has their own unique why, their reason why they're doing these different commercial acquisitions, these different deals. And even though everybody has their own unique version of it, I find that if you distill it into these five different categories, it fits pretty well. Everybody's some sort of combination of them. So I go through the importance being that you need to know why somebody's not going to throw in the towel. What's really in it for them? The first reason why some people make acquisitions is preservation of purchasing power. And it doesn't matter if you are just simply earning more than you end up spending each month, if you're just allocating a certain chunk of your paycheck each month or each year to your investments, or if you're perhaps a retiree. The fact is you need to make sure that nest egg doesn't lose a bunch of value due to inflation or something like that. And so if you're in this situation, the reason why you'd pull the trigger on your next investment would either be because inflation is eating away from the purchasing power of your cash flow, meaning it's time to make another acquisition, probably based off of a loan, based on the rest of your portfolio. But the other option is when you're buying at a steep discount. Taya was already referring to how she ends up creating a deep discount property to make it all the more likely that the flip will go as anticipated. But the important thing about this motivation is that people where this is their main reason for making the acquisition, they're not going to pull the trigger on absolutely anything. They need to have that steep discount before they're going to make it happen. And it's vitally important to understand that because some people are out there doing deals just for deal's sake. And full disclosure, this does not describe me right now. I'm not that part of my arc in real estate. What describes me better is trading time directly for wealth. And to explain that a little bit more, I need to do a little bit of a history lesson about myself. I got a tech background, and of course, when you're in tech, that makes you a high income, high salary, high wage earner. And that means that as you are, like, if you've got a lot of ambition, you're going to be going for bigger and better salaries. But if you pay attention to your tax bill, you'll notice that it gets bigger as your salary gets bigger. And I came the specific type of technology that I did. It's the CRM space, particularly making the online funnels for different successful online businesses until 2014 when I started building those funnels for a real estate company. And then when I was watching what he was doing, I'm going like, well, it's pretty clear that I'm on the wrong side of the right business. And the real trick for wealth generation is to be rewarded in the form of deployed capital, aka equity, instead of just chasing these bigger salaries. So that explains what I'm getting out of these deals or what I'm pursuing personally. But I get that that's abstract for some people. Some people are just more concerned about taking control of their schedule. If they're youngsters, maybe they want to hustle like crazy right now so that they can fast track their retirement. And that's perfectly fine. As long as they're willing to hold up their piece of the bargain, then that's all great. But one spot where I find some people with this motivation tend to be basically a little bit inaccurate in their worldviews. They think that everybody is secretly trying to retire early. And in this industry, I assure you that is simply not the case. There's some people who are going to be hustling into their 90s, especially the people that are fueled by ambition or generational wealth. They want to buy their entire hometown. They want to make sure their great-grandchildren never have to hold a day job. And so that is why they're never going to be asleep at the wheel. They're going to keep on doing deals and hustling and hustling and hustling. And even though that's vilified in some circles, it's really important to have people like this on your team, because the people who live at that property, or who use it for their business, depending what kind of commercial real estate we're talking about, somebody has to keep the place in good shape, keep up with maintenance and all that kind of stuff. And that's why I'm always happy to have people like this on my team. The last group, though, they're also similarly motivated in the sense that they're going to hustle into their 90s, but they've picked a sector of society, or maybe it's animals or the environment. Who knows what it is, but they figured out that there's also a massive financial component to making a big impact in the world, and that's why they're making their commercial real estate acquisitions. So, Taya, those are the 5 different distinct motivations I've found. What combination of those would you say describes you best?
Definitely no, I am not a retirement focused person. I actually did semi-retire middle of my career. I come from a biotech background, kind of similarly. I had a journey where I had, a fantastic experience in biotech, was a high income earner. I actually became a crypto investor and made a lot of money in crypto, and then I lost it all. So that was really my number one motivation. I wanted something that's asset backed, and I wanted to have really strong financials. So I wanted to have a real estate that I could actually touch and feel, and I could operate, that is attached to a source of income. So that was really my motivation initially, really stabilization, as well as asset-backed income-producing properties. And then I would say, particularly the space I'm in, it's affordable and workforce housing. With all the changes that are coming down the pike with all the new regulations, I think really our society is further more being pushed into renting. There are economic realities, and there are also lifestyle realities. Myself, I have potentially, invested in many properties, but I kind of prefer renting. I kind of don't want to have to deal with, my joke is, if you have your own home, you're always working at home, right? Because a lot of times if we own our properties, we're doing the landscaping and, we're the maintenance person. And I'm like, I'm good with my day job. I don't want to come home and work more. So I think we are really working toward a rental economy. And I think in any capacity, you're able to really participate in that flourishing rental economy. My particular interest is in keeping it affordable. I think you will do well because you're following a very major macroeconomic trend.
I love that answer for a few reasons. One of the biggest ones is because I think there's a certain romantic attraction I have to minimalism. So, like the Fight Club line about, the things you own end up owning you. The Jack Kerouac line, if you own a rug, you own too much. Maybe that's a little bit too intense, but I think it's probably because I was also a guitar teacher as a teenager. And so I saw some people where, they'd spend a bunch of money on a couch, but they wouldn't spend any money on a proper guitar. And like, if you're a real musician, you'd rather have the nice guitar and sit on the floor. But I digress. So I always love that motivation section because it gets us so excited about what we're doing and why we're doing it. But of course, there are risks involved in every single business, and real estate is obviously not exempt from that. Now, if you have ever been involved in an off-market deal, the SEC often calls them 506B deals. These are these private ones that you're not allowed to publicly discuss. Then the SEC attorney, the securities attorney who was enlisted for the deal, they should have insisted that everybody fills out this super invasive financial questionnaire. It's like, what's your net worth? What sort of income do you have? What sort of assets do you have? All that kind of stuff. And that's all fine and dandy. That's what they want for your substantive relations documentation. But there was one question I found was particularly problematic because I found that it didn't matter which answer somebody chose. It didn't really give you the information to find out what makes this person tick. And it was the tolerance for risk assessment question. And they were just giving a multiple choice of lots of risk or maybe just a little sprinkled on top like it's a cupcake or something. But my question is a fill in the blanks one. It is, there are many popular investment asset classes, but I think blank is too risky. So Taya, you already mentioned your crypto woes before. I don't know if you've wavered on that one, but it can be inside real estate, it can be outside real estate. What's too risky for you to invest in?
I think at this point, I would say crypto is too risky. I continue to see a lot of my friends that do extremely well. But I think at this point, I'm really interested in anything that's really backed and it has a um, cash flow associated with it. So I would imagine also real estate speculation is probably too risky for my palate. I want kind of a flow of income to de-risk my capital.
I love that. So it's the appreciation thing that you're looking to avoid. So buy low, sell high. It's not a smart enough
Oh,
move.
I love appreciation, but I don't think that should be the only lever that you pick. I think you absolutely want to have an appreciating asset, but you also want to make sure you're making income from it. So if the market turns, which markets turn all the time, right? We've experienced so many bull and bear markets. You want to just have some stability, and I think having income associated with it does really produce some downside protection from a risk perspective.
And in crypto, you can't do the value add. You can't, put lipstick on it or, fix its teeth or something and suddenly it's worth more. Whereas with properties, you absolutely can renovate and make it nicer and worth more. So, yeah, I love it. I love it. And that brings me to my next slide. Now, full disclosure, for the first 1 or 200 of these interviews, I did not include this one because I thought I was going to run into too many people who are, their investor relations or their marketing. And so they're not really the spreadsheet jockeys or anything like that. And so it seemed like it was a little bit mean to say, hey, here's, 14 typical deal metrics. Which ones are your favorite? But I found that even if you are the front of house PR marketing person, you're still going to pick, 2 or 3 that are going to help you be the curator of good deals. And so that's why I started doing them. And for anybody who's in the audience and you're only listening and not watching, I'll read them out. The first one is cash on cash. Second one is IRR, which is internal rate of return. It's also known as an equity multiple over the period of time that you're holding it. Then there's the cost per door. There's the net operating income, the going-in cap rate. Cap rates for commercial properties are publicized, and so you have an idea just by looking at the cap rate what kind of discount you're getting. So that's what that's all about. Then there's the loan interest rate, which is especially important these days when people are trying to assume loans. There's the occupancy rate, just so you know, that's the inverse of the vacancy rate. So it's the same number, just inverted. So how many people are actually renting out the different units. Then there's the average income where the property is located, the amortization period of the loan, also especially important if you're going to be assuming a loan. Then there's the difference between the market versus the in-place rents. That's some of the forced appreciation right there, just finding out if they're undercharging. Then there's the population growth where the property is located, basically baked in demand. There's the sponsorship record, which is how many deals have already gone full cycle, how many deals are on the go right now. There's the waterfall split and exit strategy, which is what happens to your investment after the business plan has been completed. So is it a fix and flip where it's upon sale you're getting your money back, and what exactly happens afterwards? Or is it a sort of thing where they pay off, the private investors, the passive investors, and then they're just basically on their own? And then there's DSCR, which is debt service coverage ratio, which basically means what sort of percent of the revenue is going out the door immediately just to pay for the loan. So Taya, again, this is not an exhaustive list, but do you want to give like a top three, or which numbers do you tend to really focus on most?
It's interesting because we do focus on really all those metrics as an operator. What I look at in the acquisition side, I really look at cost per door, I look at population dynamics, and I think there was another thing that that you had on board, but just basically rents. Those are the three things that we really take into consideration pretty significantly. By and large, a lot of those are unchangeable, and by and large, a lot of other aspects we can work on in terms of how the deal can perform and what the occupancy rates are, etc. So we have a lot of power as operators on a lot of the other metrics, but really to get into the deal, we need to have the correct price in the correct market. And those some of those things we just really need to take into consideration before we get into a deal.
I love that answer. I'm gobbling it up like a delicious, look at that, subscribe sandwich. Isn't that intense? It's
Crab sandwich, I love it.
right, exactly. It is very subtle, but it's my subtle reminder for myself that it's time to pull out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. Now, I go through all 6 sides, again, so that you can learn to more effectively communicate on the subject of commercial real estate deals and also understand how my guest fits in. But it hit me that you might watch me go through the 6 side and say, hey, I need to get me one of those cubes. Well, the good news is it's absolutely free. You can go to dandoesdeals.com, and there's this big conspicuous button where you click in it and it goes to the PDF. You can print it out and fold it up and show it to your kids and your friends and your family and all that kind of fun stuff. And yes, you heard me right. I committed the cardinal sin of marketing, which is that you should never, ever give away your freebie without asking for some sort of contact information, like an email address. But I care about you that much. That's why I made it all for free. But let's get started with these 6 different core roles. The first one is the repositioner role, which is the person who, they're a deal finder. They're the brains of the deal in the sense of they're trying to figure out how can we find more upside. So that means they're going to have to underwrite the deal, which means do the arithmetic, do the math to figure out, first of all, is this property even making the amount of money that the seller/broker claims it is? Of course, Taya mentioned that she's focused on hotel to multifamily conversions, so it kind of doesn't matter what they're doing as far as a short-term stay property. But the repositioner job is super important, just so you can find out how do we make more money with this property and increase the value value just by those decisions. And the most confusing part about repositioners, they are the most public facing, you're more likely to run into a repositioner than just about anybody else. But you might ask, what's the deal with their wide circle of financiers? Those are people who do not deal with any sort of operations. They only deal with the owners, they deal with money, and they deal with paperwork, and that's it. So they're banks, they're lenders, they're passive investors, all that kind of fun stuff. And repositioners have to know lots and lots of these people, and that's why some people focus on investor relations, the relations with the financiers. But the reason why you have to have a big circle of financiers if you're going to be in this industry is because it's capital intensive, and if you can secure a more advantageous loan, in other words, cheaper money, that goes straight to the profitability of the building. So that's why people are always pursuing more financiers. But of course, the next place that the repositioner is going to take a look at is the operations and stop those Benjamins from going down the toilet. Of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and all that kind of fun stuff. Me personally, my experience on the GP teams of multifamily has been where I will also be responsible for marketing. The reason why that is important is because even if you're looking at bigger properties like I tend to, 100 units or more, the fact is, even if you have those bigger properties, you're probably outsourcing the third-party property manager to take care of the property. But if they cannot fill the units, somebody on the GP team has to have some marketing chops to get those units filled. It's absolutely vital to make that happen. That's where I step in. And of course, my technical skills as far as like CRMs and custom programming goes, that also helps for different automations for running things as well. But there's only so much the repositioner can do to find more upside from the operations. So the next thing that a repositioner will frequently do is they'll hire a contracting team to renovate the property, make it nicer so that the future residents, if it's a commercial property where it's retail or something like that, the people who are leasing out the property, they'll be happy to pay more in rent than the previous one, and that creates that upside. But if only things were that simple, if contractors would just do exactly what they're supposed to, they keep the schedule, all that kind of thing, that'd be wonderful. But of course, the upgrades, some of them are never going to have a return on investment. Like if you're gold plating toilets or something like that, you're just throwing money away. And if you're like me, see, I don't know if you know this about me or not, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically that will not be me. I would still be stuck at an airport in an hour or two. So I rely on having somebody who lives nearby to check on the contractors, make sure they're not using subpar materials, make sure they're keeping the schedule and all that kind of fun stuff. Also making sure that if you're using a third-party operator, keeping an eye on them, making sure that they're not sloughing photos, basically misrepresenting the truth or anything like that ends up costing investors money at the end of the day. But that's the role of the local and why repositioners need them so much. But if I'm going to talk about the sixth and final side of the cube, I like to use a little bit of a hypothetical. Let's say that you're a high earner, or you're a physician, attorney, engineer, something like that. Maybe you already have a few properties of your own, and you know how that works. Basically, you save up the down payment and then you borrow the rest. So maybe you get the idea when you go into commercial real estate, you think, hey, well, if that's how it works, I see there's a 350 unit apartment complex down the street and I'd like to own it. So I bet you if I went around to my peers and I said, hey, let's all throw in $100K each or something like that, we could take it over. So you turn around to the financiers, the banks, and you say, hey, I want to buy that building over there that's worth tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us. Yeah. Well, the financier is going to rain on your parade in one very clear way. And if you're in a coaching program, I encourage you to listen very carefully to this next part, because they're going to ask you, who's the sponsor? Who's the KP? What's that all about? See, these different lenders, they're in the industry of preserving their capital. So that means they are not going to loan depositor money to anybody who's just going to use the money to run the place into the ground and then lose all that capital. So the way that they make sure that the team knows what they're doing is yes, somebody in the fold has to already own a similar asset. So in other words, if you don't have somebody who already owns a 350 unit apartment complex, you're not going to be eligible for that loan. So there's that part. You also need a certain amount of liquidity to prove that you can actually run the place. And among the GP team, you need a balance sheet, in other words, collateral of at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So Taya, you alluded a little bit to some of the roles that you'd be playing in these different deals, but do you want to fence that in a little bit?
Sure. I think most directly, I am the repositioner. As developers, we typically bring in many different groups together. We typically have some skin in the game as well, so we co-KP and sign on the deals as well. And we have an extensive network of local contractors as well as commercial real estate um, property management teams. So absolutely, I think you covered all of it, and we certainly have all of that per project on our team.
I love it. I love it. So let's talk about buy box then. And when real estate people are saying, hey, what you're looking for, what's your buy box, we're talking what's your ideal property, we're asking for three main things. First one's geography. Where is it? Which state, which county, possibly even which neighborhood? Before you use the term ideal, you're going to have to know those things. Second one's going to be size. Now, when you're talking about residential, in other words, multifamily, then the way that you define the size is by the number of doors or the unit count. And the reason why it's relevant is because the type of company that's going to take over, 5 and 10 unit apartment complexes is going to be fundamentally different from the type that's taking over 100, 150, 350 unit complexes. So that's going to be important. Now, of course, Taya already mentioned that she does the hotel to multifamily conversions. So the unit count's still going to be relevant. There are other types of commercial real estate that go by square footage, like warehousing and things like that. But that size constraint is still going to apply. So we definitely need to know what that is. But the third one is usually called class. I prefer the term desirability because there's more than one feature of it. I call it two different features. One is the condition, and then the other one is the area. If you're talking about condition, we're talking about how old is the facility, how recently has it been renovated or upgraded, and what sort of amenities are included with the property. So if it's like a hotel, does it have a great big hot tub or something like that, swimming pool, those sorts of things, on-site laundry, those sorts of things are all going to matter as far as the desirability of the property. But when you're talking about the area, there's that old saying that brokers love to say, location, location, location. I don't like that term because I think what they're really saying is traffic, traffic, traffic. If a gazillion people pass by a property every single day, it's going to have more demand than a place that's basically crickets. So you have that. The crime rate is always going to matter with any type of property. But the other one that's more or less specific to residential is the school districts where the property is located, because people will definitely want to have the best schools available for their children. But both the area and the condition are ranked the same way as in grade school, where you have A plus at the top, and then A minus, then B plus, and so on. So Taya, as far as your buy box goes, what are the specifics?
Sure. We basically say 100, 100, and 1,000. So we look at cities that are over 100,000 in population. We look for 100 units, and we look for studio rentals to be around $1,000 per door. So that's like our initial buy box. And then our focus has been typically in the Southeast and the Sun Belt is where we thrive in. And as far as like school districts, etc., our bread and butter is workforce housing. The majority of clients don't have kids, are single individuals or couples that are living in studios. So by and large, school districts doesn't matter. We do focus on Class C, and for what it is that we do, what really benefits us is places military, maybe Section 8, maybe entry-level manufacturing jobs, maybe a lot of students. So places that we really focus on have a demand for really affordable housing, and there's just a housing stock shortage overall in the city. So that's typically the environment that we operate in.
That makes perfect sense for conversions, since, rooms in hotels tend to be studios anyway or suites. So yeah, I love that. I love that strategy. So the next question then is about people, and it's about who is out there that you can disproportionately help. Now, people in real estate, it's my favorite part of this business. Of course, I came from tech, and it's true that a lot of tech people are somewhat antisocial, and so that's a little bit of a tough one. Whereas in real estate, people are so eager to give referrals, build new teams, just because it's so multifaceted. But even though we're all eager to build these new teams and give new referrals, I think there are two things to keep in mind. One of them is that it's a very capital intensive business. So everybody who's in real estate is interested in meeting more passive investors to get that cheaper money to do more deals. So everybody is interested in meeting more financiers. But the fact is we all have our own unique skill sets, so we're going to be disproportionately well suited to help some people more than others. Me personally, I always try to attract the sponsors and KPs. The reason being is because with my skill set, I'm not the type of person who works for these startups where it's going to be like 80-hour weeks every week. That's all perfectly fine for building something, but it's not where I'm at my most effective. So I tend to bring my marketing and podcasting and the tech stack help to different companies. And so those are the other guys that I'm most eager to speak to. But Taya, as far as people in the audience, the 6 different roles, who are you most eager to speak to?
I think in general, investors, we certainly operate best in a deal pipeline. So we need a lot of support with acquisitions and also capital raising. So capital makes, these capital investments go around. We're always in need of that. And I would say probably acquisitions is really critical for us as well.
Excellent, excellent. So now I'm sure everybody in the audience is thinking, but how do I reach out? And I'm going to sandbag that conversation for a second and talk about myself. You'll notice that I have this distinct last name, which makes me ultra easy to find on LinkedIn, which is the social media platform where I spend most of my time. So that is definitely how you want to reach out, especially if you want to appear on a chance encounter like this, or if you play chess, we can join for Chess with Investors on chesswithinvestors.com, where we talk about what you're passionate about in investing over a live game of chess. As far as the stuff that you see on your screen, I got this ridiculous hat that's a little bit of education for free. People who want to know a little bit more of the things that smart people can get involved in real estate and lose their shirt for no real mistake of their own. And I talk about what full-timers do to make sure that doesn't happen to them. DanDoesDeals.com has the rest of these types of chance encounter interviews. And if you scan this QR code, that goes to the Amazon.com page that sells books like books of mine like Real Estate is a Scam or Figure It Out, the Attention to Detail Handbook. But Taya, I know that we cross paths on LinkedIn. Is LinkedIn the best way to reach out, or is there a website, phone? Like how should people reach out?
Absolutely. LinkedIn is a place that I'm very active on. So again, I have a very distinct last name, Taya. Last name is Damavandi. And if you'd like to email me, our website is microloftstudios.com. You can find us on microloftstudios.com. And of course, my email is tayavandi@microloftstudios.com. So there's 3 ways to get in touch with us. We'd love to hear from anyone that's interested.
All right, beautiful. And that brings me to the last part of this interview, which is my public service announcement. So it's not so much for you, Taya, as it is for you in the audience. It is, if you've been watching this episode and experiencing searing pains in your eyeballs and like maybe migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that maybe you forgot to hit. So, okay, full disclosure, the reason why I want people to hit the darn button, it's so those deadbeats at YouTube start to pay for these videos instead of me. I think that would be amazing. And the trade-off to you, just so we're clear, is my videos may show up on your list of suggestions, but you can feel free to ignore those suggestions because quite frankly, I just appreciate the fact that you spent this time with me. Just like Taya, I appreciate you joining me. This has been fantastic.
Amazing. So Dan Does Deals on YouTube. Is that how we can find you?
Yeah, Dan Fredenberg on YouTube. I think, yeah, youtube.com/Dan Fredenberg, I think is the short form or like a little ad or something like that. But you can definitely search for me, or you can search for Dan Fredenberg and Taya Damavandi, and I'm sure we'll show up right there because that's a mouthful, all right, right?
We have the most difficult last names.
Yeah, no kidding. Anyway, thanks a bunch. This has been awesome.
All right. Thank you. I appreciate you.
Great. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Fredenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.